Joining us now to talk about it in greater detail is Mr. J. Pakirasamy, the MD and CEO of Andhra Bank, and Saswata Guha of Fitch Ratings. Gentlemen, both of you, good morning. Thanks so much for joining in. Saswata, let me start off with you first. The guest that we had earlier, just before we are having this discussion right now, said that he was not quite sure if this is yet again a false start, which it seemed like 15 months ago, or this is a bit of an improvement over that and will have a material bearing on how the banks do and how for the system and how the banks do for themselves as well in terms of stocks. What's your sense? Is this more meaningful than the promise that we had on October 25th, a year and a half ago?
Hi, good morning. We're looking at a very different scenario compared to, October last year. Clearly, a large part of the capital injection which came at the end of the last financial year, bulk of that was literally wiped off as a result of, losses reported en masse by state-owned banks. So clearly, their overall solvency positions have deteriorated since then, simply because, while yes, incrementally NPLs have slowed down, but the stock of the outstanding NPLs continue to attract more and more provisions, which clearly the P&L is not in a position to support. I think those buffers have weakened quite considerably. Now, coming to this capital injection, I think it is important to perhaps notice that, firstly, this is largely in line with what the government had initially proposed. So this additional 44,000 or 41,000, whatever the number is coming out of the 58,000 crores which the government had earlier earmarked for banks to do, which we've for a long time been saying that is not going to be that is unlikely to be raised by banks, and therefore the government would have to step in, and that's exactly what the government has done. And it is not because we have been saying it, but the fact is that if you see solvency across the PSU banking sector, barring perhaps one or two banks, it is really very weak. In fact, several banks, well over 60% of the banking system, if you see the core capital ratios are below the 7.4%. That is likely to be required for this year, and this excludes the 0.675 which was deferred until next year. So and by and large, if you sort of adjust what is there in terms of remaining equity by the unprovided NPLs, then most of the banks are looking at a solvency issue. So in that sense, if you see the extra capital that is coming in will help address some of the near-term capital needs. And we believe that most of the banks, as a result of this capital, should be able to at least meet the minimum Basel capital norms. But in terms of growth and everything, we don't believe that this capital is going to be enough to support the kind of growth that the authorities are expecting the banks to do.
Okay, Mr. V.G. Kannan, CEO of Indian Banks Association, also with us on this conversation. Mr. Kannan, thanks so much for joining in. How would you look at what's happened? I think the views are spread across the spectrum, and maybe all of them are right in some part or the other. But one belief is that this will help the decent performing banks in the PCA, come out of the PCA, and if the finance minister is to be believed, the NPA recognition cycle has peaked and the recoveries will come in full flow because of the resolution, and that will also help some of the other banks do the same. How would you look at this move and the ensuing moves over the next 2 or 3 months that will come about?
The fact that the government has actually recognized that the banks which are originally expected to raise funds from the market are not in a position to do so, partly because of the current situation where they are in huge NPAs and high provisioning. And the fact that the markets, the prices also have been pretty low. In case they raise from the market, then they'll probably be selling off shares at very low prices. And the infusion will certainly give some strength to the banks which to meet the regulatory capital. As regards the, demand, there's a lot of liquidity in the system. Therefore, liquidity is not much of a problem. There were some constraints regarding the capital because going forward, no one wanted to breach the capital. Therefore, they were conserving the capital. And I think it will give some elbow room for some of the weaker banks to come out. A few of the banks are expected to come out of the PCA. we'll have to actually wait and watch as to when the actual infusion takes place. Once they come out of the NPA, or some relaxation is given to extend additional credit to the market, I think some of the banks will come out. And many of the banks have had problems regarding this IBC also. So the IBC process has actually kicked off and been doing pretty well, but not really up to the expectation. In the sense, some of the resolution which was expected to have been done by the first half of this calendar year has not yet materialized even in the second half. And that is a bit of a worry, and due to which some additional provisioning need to be made. Earlier, many of the bankers were very confident that the resolution will give them some elbow room in the form of some write-backs or reduction in provisions. That's not happening, and that's a cause for worry. If those resolutions come, I think the additional capital requirement also, in the sense the CRAR also will be slightly better than what is even actually expected today.
Right. Just coming to you, Saswata, while we're talking about this additional kicker of 41,000 crores helping some of the banks within the PCA to meet their regulatory capital norms, what does it do in terms of growth capital? Because they've been stopped from doing regular business over the last few months since the time they've been in the PCA. So what has the gap been for the time that they've been out of action versus now when they actually move out of the PCA and start to conduct business as normal and growth to come back in for them? How does that transition happen?
Yeah. See, I think you need to look at it in two parts. One, of course, is that if you look at the current growth in the system, which at an average level it looks quite good at around 15% if one has to go by the latest reported numbers. But it's important to recognize where that growth is coming from. A large part of that is obviously being driven by the private sector banks. And of course some large public sector banks as well. But if you look at within the public sector space, there are still banks which continue to degrow or grow at very low single digits. And partly because one, of course, is capital, but many of those banks, even as of the first half of the financial year, had continued to report losses. So I think there is a reason why these banks have not been growing. Now coming to the capital, so and if you see the capital levels in most of these banks, I think in many cases there is a significant deficit, and by that I mean at least 100 to 150 basis points from where their core capital levels are currently to where they need to reach. And our belief is that firstly, the incremental capital that is going to come their way will be used to bridge that gap. Secondly, there are these incremental provisioning needs which will obviously take precedence in terms of their demands on capital. So I think a large part of that, in my opinion, will probably get consumed in that. And then finally, what is left will potentially be used for growth. Now, the third part, in our view, is not going to be much. There's not going to be much left for many of the state-owned banks, and which is why we are a little less optimistic on the growth aspect. We think that a lot more capital is going to be needed by the PSU banks for them to be able to sort of go back to their long-term average growth. But at current levels and with the current expected capitalization, as I said, we think they'll be able to now negotiate without the risks of breaching regulatory capital buffers, but they're unlikely to post any meaningful growth, at least in the near term.
Right. Mr. Kannan, would you agree with that? That growth for these PSU banks will remain a question mark, and the part of the pie that actually goes towards growth capital is going to be a very small sliver?
See, one of the expectations of, for the reduced infusion earlier was that the provisions which had to be made for the IBC process, many of them will be written back. And we expected that many of the large accounts will be resolved. And most banks have actually provided up to 100%, maybe a couple of banks have slightly less than 100. But then if they are in a position to get even a 15% or 20% haircut and then we get the remaining, they will have a huge rate back, and that will certainly improve their position regarding capital. So this is something which banks are still hopeful that and they will probably materialize by the next quarter. If that happens, I think that will probably be one of the areas where it will give them additional growth capital. It's right that the funding by the government has been to ensure that all the banks meet the regulatory capital. Additional capital for the growth is right now not available. But except for two banks which have been told not to do any lending, I think most of the other banks have been lending to the retail sector or for the low risk category. So they have been doing it very, very cautiously so that they are in a position to conserve the capital. This will give them some elbow room. And if the IBC process, which I think a lot hinges on the IBC process, if that happens, I think many of the banks will get fairly adequate growth capital to take it forward.
Well, one certainly hope that happens, but let's wait and watch whether it happens and how soon it happens. But Mr. Kannan, that point is well taken. I would have loved to ask a question more each to both of you, but perils of a live feed and sticking to a timetable, we'll have to wrap up this conversation here. Thank you so much, gentlemen, for joining in today and giving us your thoughts. Really appreciate your time.